Okay, Josh, a member here asked me to do a real quick video on the charts. Um, though it's great, it does have charts. Just go to your trade page, look up any symbol, click on the quotes tab right here, and you'll see a chart pop out. And then you can expand the chart right here. Okay, and it does have a volatility chart as well. So here's a 52-week of the SPY chart, and you can click on volatility, and you can kind of see if volatility is at kind of at the higher range for the year or the lower range for the year. As you can see right now, it's at the higher range for the last 52 weeks. Good time to sell premium. Now on Thinkorswim, here's a standard SPY chart. I've shared this chart many a times. I'll make sure I share this chart again with this video link. I'll attach it into the comments below. Just copy and paste. In fact, before I forget, I'll just go share here. I'll create a link for sharing, and I will share everything. I'll hit copy, and then I'll just paste it later into the video and on the posting. Okay, so real quick, the studies I have here, if you click on studies and you go to edit studies, all these studies will be in that link. So I have a moving average, 13 and 21 exponential, and I also have the 233-day moving average. I have Bollinger Bands, 2 standard deviations away. All right. I also have the price percentile code. What that means, if the price has changed more than 5% in a 10-day work week, it'll light up green. The IV chart is this price is right here. This chart, that study is right here. This is the IV rank percentile code. All this does is tells you what the IV rank is of the stock. Right now it's 39.5. The VIX tells, that means if the VIX and the S&P/Y move within the same direction, it'll come across, and that usually signals a change. I hardly ever use that. Very rarely happens. Okay, you're also going to see these arrows right here. Moving average 1321, 1321, and 1323. All those are right here. Wait, I can't really. Okay, those are just these green arrows, right? You'll see these arrows over here. Whenever the 13-day moving average crosses above the 21-day moving average, you'll see this green arrow, and it's usually a bullish signal. See, and then when you see yellow, it's when the 1321 has crossed below. You know, the 13 moving day average has crossed below the 21-day moving average, and it goes down like that. It's a bullish, bearish trigger signal. Okay, that's all that is. And if it happens to cross over the 233-day moving average, you'll see a bigger green arrow or a bigger yellow arrow. IV rank, that's this chart right here. Hold on. That's this chart right here. So all it does is plots your IV rank. In Thinkorswim, it's called the IV percentile. Those are the same thing. And it gives you this yellow bar right here. So if it's yellow, it's kind of mid. If it's green, it's above 50%. This green line, everything, this whole box will be green. If it's red, it's below like 25. It'll be red. In the middle, when it's in between 25 and 50, it'll be yellow because it's kind of like in between, you know. That's that one. OBV cross. Oh, basically how you use that simple is when you want to sell premium, especially when IV rank is above this green line or 50. And you want to sell premium, so you're selling this vol collapse. IV rank is pretty much the most important thing other than liquidity. Why? Because IV rank is the only thing that can revert to its mean. Price does not have to revert to its mean. Okay? So what goes up doesn't necessarily have to come down to back where it was. Look, here's the low. If you were to bet that it came back down to the low, you would have lost money all year long. But if you made a bet that IV rank got as high as 100 or 80 or whatever, if you have to make a bet that it'll get back to its mean, which is below 50, it always did. Okay, even below 25, if you want to bet that it'll get above to 50, it always did. Or 250, it always did. It just took longer. But IV rank always reverts back down to its mean. Price does not have to. This chart right here is OBV cross, meaning on balance volume. On balance volume is just a technical indicator for if there are more people buying than selling. I created this study to just say, hey, whenever there are more buyers than sellers, of course it'll go up. However, if it crosses its 30-day average, meaning more buyers than sellers over the last 30 days, it'll turn green like that. Okay, that's usually a good buying signal or a good bullish signal. You can tell right here, every time it went green, look what happened. Okay, every time it went red, look what happened. I'll show you that a little later. All right. Okay. Now, shared slow. This one right here is the 39-1 slow stochastic, which is not the usually slow stochastics people use. The settings are right here. I have them shared somewhere, but they're here. This one right here. Okay. So all that means is when it crosses 50, it'll turn green. Okay. Here's 20. Here's 80. Here's 50. So that's all that means. When this both goes green, it's usually a very good bullish signal. When they both go red, especially at the same time, it's a bear signal. So look at right here. Everything lined up perfect back in October of last year. Look, it turned green on the unbalanced volume. It turned green right here, and then it both crossed above 50, right? Look what happened right here. Then it turned the green arrow 1324, that's like the trifecta, and then look what happened. It's been bullish. Actually, if you just stayed long here, you would never have lost money, right? Okay. In fact, if you just got out with this trigger, you would have made money from here to here, right? You could have shorted or waited. You could have gotten back here, and then you would have waited, got out over here. Then you wouldn't have got back into here, and you waited. You would have got up into here. Same thing, right? You could have gone in here, and you just waited and got out to here. You would have made money 100% of the time. Okay, that's direction. That has nothing to do with volatility. All right. So let me zoom in for 3 months, and you can get a closer look. Okay, so the light blue line is the 13-day moving average. The pink line is the 21-day moving average. As you can see here, there's a yellow arrow right there. That just means the 13-day cross below the 21-day moving average. Triggered that yellow arrow, which is a bearish signal. You could have gone sell some calls, I guess. Actually, yeah, you could have sold calls because look, IB rank was high. You want IB rank to drop. You're betting it'll be lower than here. You know what I mean? So if you sold a 1 standard deviation out of the money call, you probably would have bet that the SPY would, stay above here. I mean, stay below here, and you would have made money all the way down. Look right here, yellow arrow here. Okay, but here's where it gets subjective. Here's a yellow red arrow here, right? But look, OBV crosses all the way down here. It went red here. It went red here at the same day. Look how early you would have gotten short, and you would have caught the move down. So that's what I use these for when I do my golden geckos. If I'm trying to bet, if I want to see if I'm skew the golden gecko bearish or bullish. For example, I saw 100% IB rank in PBR. Whoops. A couple weeks ago, I think, or a couple days ago, I put it in the forum, and okay, and I was bearish. Why? Because I saw this and this, so I sold calls, right? I sold calls, and look, see, I'm fine in it. And why? Because I'm betting on IV rank to collapse, and I was right on direction. Here's an important rule: I was right on direction, right? But I'm making some money, but I would have made more if IV rank collapsed a lot further. Okay, so I think I shorted the 18 calls, meaning I sold the 18 calls. I was betting that P bar will stay below 18. Okay, and so I'm right. Okay, but I'm not making as much money as I could because I need IV rank to collapse. The reason why IV rank is not collapsing is Brazil is having their election. The election on October 5th, and this is a Brazilian stock. But anyway, that's it. Oh, Bollinger Bands, real quick. I'll review Bollinger Bands. I'll zoom in to right there. This blue line is, this bottom white line is a two. My Bollinger Bands are set for 2 standard deviation at that time. So this top line is the 2 standard deviation on the call side. This bottom line is a 2 standard deviation on the put side. At that time, though, not 45 days out to expiration. That's just at that time. What do I use this for? I like to look at the width, if it's contracting or expanding. Why? Because if I see if it's contracted like this, I know I'm going to see a move, and I use that with IV rank, right? So if I see this, I know I'm going to see it expand. So I know I want to make sure volatility is going to rise, and I want to make sure I place my positions accordingly. All right. Another thing that can, so for example, if it's expanding and I know these are 2 standard deviations and see how narrow they are, I know that when I sell my 45 days to expiration strangle, or Golden Gecko, I want to make sure I set them wide, and I know it's going to be, I have a better chance of it getting tested because I know these are going to expand. Okay, so one thing good about this is if you see um, high IV rank and the Bollinger Bands are wider, like look right here, see how it's high, it's above 50, and see how wide the Bollinger Bands out. Those are great times to sell strangles. Okay, why? Because you know IV will collapse, and you know the Bollinger Band more than likely should contract, so you have a better chance of it staying within those strikes. Okay, um, so another way of looking at it too, and I haven't really tested this yet, I will, is if the Bollinger Bands are wide like this and you have a higher IV rank, I guess, is it a good time to sell a straddle? A straddle is where you're betting the stock will basically stay at the same price. Okay, so I would have been kind of scared to do that right here because it's just started to expand. I don't know how wide it can go. But look at down here, it got pretty wide, right? And it's still above 50 decreasing. So if I sold a straddle, I would basically be betting that the stock will stay at within a range of 190, right? You know, not too good. So what you want to do is you want to do a strangle when it's wide and you think it'll constrict and when IV rank is high. But when IV rank is low and the Bollinger Bands are wide, those are the best times to do a straddle. For example, look, they got wide here, IV rank is low, and if you sold a straddle, you're betting that IV rank will drop and the price will stay the same. You see how the price stayed the same because they got narrow? So your straddle would have been great. You also wanted IV rank to drop, and you can see right here it did. It was, what is that? Here, and it dropped down to here, right? And even down here. And the price still relative to the same, your straddle would have made a lot more money, and you would have collected more premium. Okay, so that's basically my charts. It's really boring. I used to use this more, except for the IV rank when I used to swing trade. But now that I use it to sell options, you could do it the same way. Uh, I'm not advocating one or the other. I'm just telling you what they're good for. If you want to buy calls, like you're betting it'll go higher, or buy puts, you could technically buy an in the money put right here because you see this green arrow. And if you buy a put, see the thing is, whenever you buy options, you're betting that the IV rank will rise. So you wouldn't. I mean, I guess if you're bearish, you could buy a put. You're betting the stock will go down. You want this to turn down and go red. You want this to go red, right? And you want IV to pop. That's how you make your money. Um, as far as the market outlook, I'm really kind of, I want volatility to pop, but I just don't see that happening as much. I'm a little worried about for Tom then because they might be in for world hurt. Here's why. Um, there's other charts you can look at, but see how all balance time is already kind of at the bottom, which means if it's at the bottom, usually, it's in a range, right? Just like anything else. It's at the bottom, now it's got to turn up. All the bears can hope for is it'll bounce off this and come back down, kind of like this, okay? Um, it's a little bit harder because this is flattened out. You can look at other studies too, like if I add, like I can make my chart really messy. I have 30 seconds. I'm gonna make my chart really messy, so I'm gonna load a study. I'm gonna load my wait, what is it? I forgot. I'm gonna load study set, the kitchen sink study set. So this has everything in it, but there's a different slow stochastic here. The normal 25.3. But you see how it's all the way at the bottom here, okay? And it's about to cross the yellow one, the yellow line, which is the 3. If it crosses above this yellow line and it's the bottom, it's kind of like the move is over. See like how the move is down here? Okay, see how it's down here? And this is down here and this is down here. The move is kind of over and the market rebounded. So I'm not positive yet, but that's just how different things you can look at. And you can see these are the styles. So I'm just going to load a style right here. And this is a clean chart. I try to clean it all up. All right, hope that helps.